Understanding lead banks, their role and functions in loan syndication and securities underwriting. A lead bank is a vital institution in the world of finance, playing a key role in both loan syndication and securities underwriting. Traditionally synonymous with the term lead underwriter, this bank oversees the arrangement necessary for syndicating loans and creates underwriting syndicates for new securities. In essence, a lead bank acts as a coordinator, ensuring the smooth facilitation of transactions among various financial actors. This article aims to delve deeper into the function and significance of lead banks in the financial landscape. Key functions of a lead bank. Coordination of loan syndications. When individuals or corporations need large sums of money that may exceed the capacity of a single lender or fall outside that lender's risk tolerance, they often turn to loan syndications. In this scenario, multiple banks come together to provide the required capital while sharing the risk associated with the loan. The lead bank in a loan syndication compensates for the significant responsibility it undertakes by collecting a higher fee, sometimes up to 10% of the loan principal. This fee reflects the extensive work that goes into coordinating the deal and fulfilling ongoing reporting obligations. Specific responsibilities of a lead bank in loan syndication include: overall management. The lead bank manages the entire loan process, from initial assessment to final closing. Financial assessment. It analyzes the borrower's financial health and market conditions to determine the loan amount and terms. Compliance. The lead bank ensures adherence to regulatory requirements throughout the loan lifecycle. Monitoring. It continuously monitors loan performance and handles any reports required by syndicate members. Securities underwriting expertise. In the realm of securities, a lead bank aids companies in raising capital through public offerings or private placements. During an initial public offering, IPO, for example, the lead bank is responsible for establishing a group of underwriters, effectively forming an underwriting syndicate. The advantages of this approach include distributing risk and pooling resources for a large financial transaction. Beyond merely bringing together capital from various investors, a lead bank undertakes roles such as valuation and pricing. The lead bank evaluates a company's financial standing and broader market factors to determine the initial price and quantity of shares to be issued. Marketing. It plays a crucial role in marketing the security to potential institutional and retail investors, leveraging its network and expertise. Sales coordination. The lead bank typically manages the sales process, ensuring that raised funds align with the initial projections and company goals. Fee structure and revenue models. The lead bank's pivotal role carries with it the promise of a more generous fee structure than that of syndicate banks due to the additional coordination and management responsibilities. In loan syndication, it's not unusual for fees associated with such arrangements to significantly increase the overall borrowing cost for the issuer. Similarly, in underwriting securities, the sales commission can account for a substantial portion of the revenue generated through IPOs, typically ranging from 6% to 8%. The importance of lead banks in financial markets. Lead banks occupy a central role in facilitating liquidity and expanding financial access to larger loans and public markets. By managing syndications and underwriting, they help streamline complex transactions, lower the risk for individual lenders or investors, and make institutional financing more accessible. Moreover, lead banks can enhance investor confidence, ensuring transparency and regulatory compliance during substantial financial endeavors. This contributes not only to the health of individual borrowers or issuing companies but also fosters trust in the broader financial ecosystem. Conclusion. In conclusion, lead banks are pivotal players in both loan syndication and securities underwriting, acting as coordinators and managers in these intricate financial processes. Their ability to consolidate risk, navigate complex regulatory landscapes, and ensure the efficient flow of capital marks them as essential entities in contemporary finance. By understanding the relevant dynamics and roles associated with lead banks, stakeholders can better navigate investment opportunities and lending scenarios in a multifaceted financial landscape.